Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are views of Naren, arguably the largest money manager in the country, on what he made of the budget, what for the equity markets post the budget, and frankly, since we are just at the start of the year, so to say, how does he expect 2022 to shape up on by virtue of the multiple challenges that the equity markets are facing? Naren, great having you. Thanks for joining in. I hope all is safe.
Yeah, everything is safe. I think we're through with the worst of Omicron, hopefully, and things are going well.
Yeah, cross fingers. It's good to see you in office, Naren. Believe me, the last 3 or 4 conversations that we've done, you've been out of home. You being in office is good to see. Naren, let's start off with the basics about what did you make of the union budget, the pros and the cons.
Yeah, I think the first thing is it is too much to expect now that the budget is a big event because first of all, we have to accept that bulk of the work has already been done over a period of time. So GST Act has ensured that a lot of what has to happen in indirect taxes has been pushed out of the budget. So for the budget to be a very big event is something that we all want to believe, but it can't be such a big event. So that is about the reality that we have to accept. And so that I think itself is important. And so I think what really transpired from the equity market side was that it was a good budget from the equity market side. So, in my dual hat of what I look at in fixed income, and that is where I think the markets got a bit spooked. Because at the end of the day, a borrowing program of 15 lakh crores is not a small amount. What it means is that somewhere every week the government has to borrow something like, if I assume 52 weeks, you're talking about 25 to 30,000 crores every week. That I think is really the challenge, if you ask me, which has come out of the budget. And that I think is a real thing, because from an equity market point of view, you have a buoyant economy, you have a buoyant corporate sector, you have a buoyant retail sentiment, and you have everything going for it with the exception of valuations. There's nothing in the budget to say that there's something which has been stopped in the budget. Everything is going smoothly. Virtually, there are very, very few taxation changes. So what has changed? Nothing negative. So nothing negative is equal to something positive. So I would say that there was nothing wrong with the equity market from the budget point of view. With 25 to 30,000 crores having to be raised every week in debt by the government is not a small figure.
Yes, it is. So, Naren, typically, I mean, you've told me so many times in the past as well that over a slightly normalized period of time, equity markets tend to follow the bond markets as well. They get a large portion of their cues from what the bond markets are doing. It seems to be a bit of a challenging year for the bond markets, if you will. Never mind the possible inclusion in MSCI. How would you therefore believe the challenges lie ahead from RBI's perspective in terms of policy making and in terms of the cues that the equity markets and other asset classes derive from the bond markets?
I think that is where the challenge is. In India, we are not used to thinking of cost of equity and various other things for any retail investor. But if you look at it, I think that challenge is going to at some point of time shape up. How did the retail equity bull market start in 2020? It started off with the fact that fixed deposit rate came down sharply. So then many investors asked the question, should I invest in fixed deposits or should I put money in retail? Should I start trading on my own in equities? And that is how this entire bull market started. And then investors made good money and they continued with it. So today with interest rates going up, they are all got used to the fact that they are trading equities. Should they now invest in fixed deposits or should they trade equities? This is a question that many investors have to think. And this is where the big challenge is. Do they come out of equity markets before they lose money? Or do they come out when things are good and invest in fixed deposits and debt mutual funds and asset allocation oriented products? This is going to be the very interesting thing, because, in my 32 years of investing, that I have seen people come out after making losses and do these things. But if they did it when they were making money, like they are today, in a very, very, very big way, then it will be very interesting. But will they do it before making money, before losing money, or will they do it only after losing money? Like, I've been a stockbroker between 1994 and 2004. I saw two times in 1998 where they said, now I'm going to move into fixed deposits. And in 2002, they said, I'm going to move into fixed deposits. Both times they did it after losing money. And that is, I think, the most interesting challenge that I would say retail investors have. Because today everyone is sitting on a huge pot of profit across stocks, across companies, across everything. That is the interesting challenge I believe that people have.
Yeah, and which is why maybe the applicability of products like balance advantage funds. We'll talk about that, Naren, at the end for sure. But we'll come to the mutual fund part in a moment. Just a couple of follow-ups to this. So, do you reckon, Naren, and we'll come to the budget bits as well, but since we're speaking about the markets, do you reckon that there is a fair probability that the markets could have either a price or a time correction or both as the major part of 2022 because of the factors that you just outlined?
See, the question is when. Having watched US equity markets for some period of time, there were a number of loss-making companies in US. And those loss-making companies kept going up. They kept going up. They kept going up. Suddenly, in the last 4 months, they just collapsed. But, they kept going up. When did they go down? Suddenly. So like that, there is a situation where there has to be a price and time correction, but from what level, from what time point? Those are all very complicated questions, and it's very difficult to say when it will happen. There is no guarantee it needs to happen from 2022 February, or it needs to happen from 2023 February. Sure. All we can say is that, the big thesis that we had in 2020, June, July, August, September, we were bearish and we went wrong. So in October 2020, we realized that where were we wrong? We were wrong because we were in a central bank bull market. And when we were in a central bank bull market, we were not fighting valuations or fundamentals. We realized we were fighting the global central banks. So then we called it a central bank bull market and told everyone, you're in a central bank bull market. So then what happened was, as an AMC, we launched new fund offers like ESG, Business Cycle, Flexi Cap, because we said we are in a central bank bull market. And what we feel is that the central bank bull market was over in November 2021.
Okay.
The day the Jerome Powell of the US Fed said, no, I'm no longer believing inflation is transitory. I'm going to do taper and I'm going to increase interest rate. The central bank bull market is over. Now, once you move out of central bank bull market, it means that you're going to have respect cash flows, you're going to respect valuations, etc. So, which means that you are in a period of volatility. That period of volatility does not mean, as some people think, markets will just keep going down. Definitely not. Period of volatility means that there'll be periods where markets go down, there'll be periods when market goes up. And the task of making money is not going to be as easy as it was between March 2020 and November 2021. The day the Fed chairman again comes and says, no, I'm going to start printing money in a big way, then the task of making money in equity markets in India will again become very, very easy. So I think now the task of making money in India will become much tougher. And that does not mean you're going to have one-way down markets. You're going to have down markets, you're going to have up markets, you're going to have down markets, you're going to have up markets. And it makes the task of making money much more interesting and tough if you ask me.
Yeah, tough for sure. Naren, just a quick follow-up. Your peers on the global front have been consistently selling Indian equities, while you and your Indian colleagues have been, mutual fund people have been buying. Some points that a couple of people who are bullish raise that as much as there are headwinds for Indian equities in terms of valuations and other factors, India promises to be the only major economy having some meaningful large growth at a point of time when both US and China, at least amongst others, will not be able to show growth. And that should drive the comfort in the Indian story, and people might be okay with the higher valuations as well. You believe in this argument, or are there challenges to this argument?
See, India is a structural bull market, I would say structural growth market. Simply because the demographics is superb. You have working age populations which will keep going up for the next 2 decades. So India is a structural growth market. The kind of growth that we talk in most products in India are much higher than the growth that we talk in most products in other parts of the world. But just because we are a structural growth market, people believe that stocks will just keep going up and valuations you can give any amount. That part of it is not true. Just because we are a structural growth market doesn't mean you're not going to have bouts of volatility. And when you have more than $600 billion of foreign money in India, you are going to have that bouts of volatility. And the fact is that, if you take the last few months, you have had a situation where the interest rates have gone up. But because Indians don't want to invest at all in fixed income, through fixed income, debt, mutual funds, what happens is they are very, very equity oriented today. So what happens is that the markets are not obeying certain simple rules, like cost of equity goes up, equity valuations have to come down. But in India, cost of equity goes up, equity valuations go up. So because for Indians, debt mutual funds don't exist. And that is the interesting aspect. So what we believe is that there is a structural growth market like India. But to believe that structural growth market like India, you're going to see a situation where the markets won't be volatile, I don't think so. We are going to have fair amount of volatility in the next 3 years, much more than what we've seen between March 2020 and November 2021. And that volatility will go down the day Jerome Powell of the US Fed comes and says, I'm going to start quantitative easing. So wait for the statement of Jerome Powell to say that we're going to start quantitative easing. Then the volatility will come down. So in December 2018, Jerome Powell said, I'm going to stop quantitative easing, the tightening, and stop quantitative tightening. From that time onwards, some global markets kind of improved. Right. So again, we have to wait for that statement of the US Fed to say that we're going to start quantitative easing or stop quantitative tightening and increasing interest rates. So till that point of time, we are going to see volatility. But again, volatility does not mean markets going down only. Sure. That I think is something people have got around to believing, that volatility means markets going down only. That is not the case. You're going to have periods of time when the market goes down, then periods of time when the market goes up. And but having said that, it's not going to be an easy time to make money like March 2020 onwards.
That's true. Just one final follow-up on the markets, and then I would want to bring in the budget angle back again. But Naren, do you think, because the first quarter has been bunched up with so many events, we've had the budget out of the way, but we'll probably see the first of the hikes, so to say, from the Fed. We will have the state election verdicts and the uncertainty around that, because it's a very long drawn 7-phase polling period in the state of Uttar Pradesh, and that might have its own implications, so to say. And of course, Russia, Ukraine, and oil prices being what they are. Do you reckon the volatility that we speak about for 2022 could be even more heightened in February and March?
I think it will be heightened, but it will be heightened for quite some time. And okay. I think, see, when valuations are high and central banks are in hawkish mode, you are going to have it.
Got it.
And I think we will have to accept it. And see, volatility has its own positives, that you can try to make money out of volatility. So it's not that volatility is a bad word or something like that. So I think volatility is going to last for quite some time. I think the moment central banks dampened volatility for too long by taking over control of everything, and now they realize that due to that we have had inflation, oil going up, so many things going up, we are going to have volatility from here on, and we have to accept that.
Okay. Then just drawing the string back to the budget, and while yesterday the 35% growth in capex number was very much lauded, I think 24 hours out, there have been some, how do I say, question marks around how strong that number would be. So one of the notes says that against the headline capex growth of 35%, as mentioned in the speech, the actual core infra and defense capex growth is budgeted at about just 7% because the gap is partly addressed by the accounting factor of IEBR funded road capex by NHAI onto the government balance sheet, etc., etc. Nomura has written a piece on that. Morgan Stanley has written a piece on that. You guys would have thought this through. Is the capex bullishness a bit misguided, or is it still a strong number even if it's not 35%?
I think overall, if you look at it, the government's approach has always been don't create a consumption boom which leads to trouble. So if you look at the 2009 to 13 phase, we had current account deficit going out of control. And you had oil subsidies going out of control. If you look at what has been done very successfully now is that you don't have current account deficit going out of control and you don't have oil subsidies going out of control. And you've been very careful in ensuring that you're not created a consumption boom going out of control. So that means that automatically you recognize that capex is superior than consumption. And that itself, whether the numbers are 24% or 23% or 16%, the fact that you have not taken current account deficit to record high and you have not created oil subsidies like what you did at one point of time, that itself is a big positive if you ask me. You don't need to have a specific number in capex. That number can vary. But as long as you don't start inimical things like oil subsidies and start doing things like, start creating a new set of problems like oil bonds and all that, I believe we are through with many of the problems. It doesn't matter whether the capex budget goes up X% or Y%. I think that is more important than anything else, if you ask me.
Okay, so you are not too perturbed by this thing. And do you like the nature of the capex spend that has been announced?
See, that we will see at the end. See, for example, one of the real problems in the economy is the way discoms are handled. So if the money which is given to the states is used to solve the discom problem and the discom problem does get solved in the states, it is, even if it is not capex, but the discom problem is solved, I think it's equal to multiple times capex budget, if you ask me. So finally, what problem, like if you ask me in the last 7-8 years, the oil subsidy problem has been resolved. Now there is a discom problem that has to be resolved. If the government finds a way of solving the discom problem through some route, giving interest-free loans to states, I think it's a massive achievement, which you can't explain. So what if it is not capex? You have solved the discom problem. If you have solved a kerosene LPG kind of or petrol subsidy kind of problem, now you solve the discom problem. It's a big achievement. You've created a very good energy system then. So it depends on how things move. And that's what we have to see. For example, GST has created a national tax regime, which is very good. You managed to create through Aadhaar and various ways so much of digital things. I don't think you would have been able to vaccinate 100 crore people without Aadhaar and COVID app. So I think a lot of things, if you manage to digitize land record and for that some subsidy is given, it's a great achievement. So I believe that, there are things that have happened in the last 10 years through digital and internet and technology. Even if whether you call it capex, you call it operating expense, hardly matters because some of these things have actually led to massive benefits. True. So if you recall how events could have had to be done and now how digital events can be done, such a massive improvement in efficiency for everyone around you.
Most certainly, most certainly. Okay, Naren, so in which case, last couple of questions, Naren. You reckon that there was some gripe on social media about how there's not much that has been done for the MSME sector, as well as for needling some bit of consumption at the lower end of the strata. You reckon that's by design, so that a lot of things don't go out of control? Because some people do believe that that particular pocket needed some handholding at these difficult times, and that has not been done.
Yeah, actually, ECLGS extension by 1 year was one such step to help them, I guess. I think the government is grappling with a proper, efficient model to help these people. So I think the only thing which they realized was giving people rice at low cost, rice and wheat or whatever at low cost through PDS was one such route. Otherwise, the government is grappling, how can I dispense such things to the poor without creating a problem? And I think government seems to be struggling there. That's what I think, because otherwise they would have come up, because I don't think the government is keen on not supporting them.
Of course, of course.
But that's why the food subsidy model of giving them low priced rice or wheat is one of the models that they have. ECLGS is another model. And maybe they'll come up with some versions of ECLGS. I do not know whether the UP election code of conduct also had a role in not bringing out many more schemes at this point of time in the budget. And maybe post the UP election, they'll come up with some more schemes, because maybe that was another code, but I'm not aware of these things. Because I feel that over the next 6 months to 1 year, they will have to find ways to support. Maybe UP election code of conduct had a role to play, and I would not be aware of it.
Fair call. Naren, so from a market's perspective, I'm just trying to think. You already laid out the big macro and the big picture. Just a couple of minutiae before we wrap up this conversation. Would you be, you know, to be very bullish on value per se? Would you, in these next 12 to 18 odd months, where is it that you believe equity markets will reward? Would it be value stocks? Would it be export-oriented value stocks, companies which are made in India but cater to the world, or companies which are inward-looking because of lots happening within the country on defense, on capex, on green hydrogen, what have you?
So I think it's easier to say sectorally right now. So if you look at it, banks have a lot of scope, considering that they had very low credit growth for the last 3 years or 4 years. So, and they don't seem to have big NPLs at this point of time, or an NPL cycle in the near term. So banks are clearly in a good shape comparatively. Second is auto, which has gone through a very, very big down cycle for the last 4 to 5 years. You have pharma. Between pharma, IT and FMCG, IT has done very well. FMCG is still at elevated valuations relatively. And so pharma looks much more attractive relative to these two sectors at this point of time. PSUs, the government has been very careful in handling PSUs over the last 2 to 3 years. There has been selective re-rating, but there is much more scope for re-rating at this point of time. So I would say that banks, auto, pharma, PSUs represent some of these things. I wouldn't call them value or anything like that. I would rather say these are sectorally areas which look interesting. From a growth-oriented perspective, I would say that people like infrastructure and capital goods, because there has been a long down cycle even today. Although the sector doesn't appear cheap, cyclically, they may still do well because there has been a long down cycle. And in my opinion, for people who have very high growth orientation, IT still looks okay for people with a growth orientation. And in my reading at this point of time, small and mid caps are something where you have to be very selective on at this point of time. So you have to choose the sectors carefully at this point of time. This is how we look at it from a sector point of view.
Okay, my final question, Naren, and that is the two export-oriented themes which you believe that, you mentioned one which is growth-oriented, which is IT. I was thinking maybe spec chem also falls in that bucket, wherein at least the corporate commentary is that there is a lot of growth on the global side, but the valuations are not necessarily in the comfort zone, if you will. How do you juxtapose them? Therefore, would you believe that high growth will take care of the slightly higher valuations, or could there be a mean reversion of sorts?
As an AMC, we've not currently believed in them because we think that the valuations are far too high at this point of time. Because we don't know whether China has genuinely walked out of the sector or not.
Okay.
Because if China does come back and start competing, what we feel is that some of these premium valuations which are there can't sustain. So we've been very cautious on that sector. And so I don't think we are believers in this kind of a premium valuation in that sector.
But even for technology, Naren, I mean, just wondering.
See, technology looks good, but it's not a cheap sector. It requires growth to sustain. See, frankly, the growth for the next 9 months, people have visibility, next 9 months to 12 months.
Right.
The problem in that sector is whether you have visibility for 2024. And that is the challenge which keeps coming, that, people have visibility for the next 1 year. That part of it is clear. But whether you have visibility for the next 2 years, 3 years, 4 years, that periodically people get doubts. That's where the question comes. And for valuations to sustain, you need visibility for the longer term. The visibility for the short term is certainly there.
Naren, final question. Balance advantage funds, you reckon are the recipe for success?
See, actually, what we believe in is, for example, we believe in fund of fund as a category. And in that category, for example, we have debt, equity, and gold. A fund called Asset Allocator Fund of Fund, which can invest in debt, equity, and gold.
Okay.
And after the first rate hike, we think gold can do well. And so in America. So similarly, for example, today passive is a very big way to go. So we have created a category which again can invest in equity, debt, global, and gold, totally on the passive side. And because it's on the passive side, the maximum expense ratio that SEBI permits is only 1% on the regular plan. So that is another thing. So we are saying that do something more innovative and interesting, where you invest in debt, equity, and gold through the fund of fund categories. And so that is what we are looking at as a way of looking at asset allocation at this point of time. So you invest in debt, equity, gold, or you look at debt, equity, gold, and global ETFs. And today, passive is the way to go for many people. And this is passive. You invest across all the asset classes through a multi-asset construct.
Got it. As Naren, the macro, the micro, the minutiae, and the big picture, as well as behavioral. Thank you so much for talking to all of this, and wish you a great 2022.
Same to all of you and your viewers. Thank you
so much. And viewers, thanks for tuning in.